Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. Today we are up around 25 basis points and we have about 2 hours left in trading. On the 1 hour MACD we are pointing down, so there may be some relief in this very nice upward movement. So I do see us hitting negative MACD soon, but I do see possible support on the actually at the moment we do see overbought RSI as well, and we start to see the 4 hour MACD begin to diverge as well. On the daily chart we see that we broke out of the 50-day moving average, which acted as resistance back in April 30th, actually August 30th, and back in August 22nd, and another back in August 8th. So we did make a very nice breakout, and we do have a good possibility we may encounter a new all-time high as well. And as we see here on the daily MACD, we start to point positive now. So since we are above the 50-day moving average, that acts as support since the price is above that. So we do see a possible support if we do lose steam and head down lower. And as for the upside or resistance, the all-time high acts as our next resistance. And if we were to move on higher, that price movement is roughly around 1.6% and actually 1.06%. And if we move down lower, that price movement is around 1.4% lower. So since we're above the 50-day moving average, this yellow line, we have this as a real good support for the uptrend. So let's head to the forecast model. On here I'll go day by day, where the S&P 500 will head to in the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these forecasts we should focus on? Ideally, the model that is the best match to the current trend. We have the current trend right here, and the trend below it is the best match to the current trend, and this dates back to December 21st, 2006 to March 22nd, 2007. I believe this is the best match to the current trend. Let me point out why. So what we have here in the beginning of the trend, we started off above the middle Bollinger Band, and then we proceeded to lose steam and break down lower to touch the bottom Bollinger Band right here, and as indicated as a red circle, and then we proceeded to move on higher, reverting back to the mean, and we see it bounce around to the middle Bollinger Band, and we proceeded to move on higher right towards the end right here. So we have those points. So let's move on to the trend in question. So in the beginning we have the up channel for several days, and then we proceeded to break down lower to touch the bottom Bollinger Band right here, and next we see it revert back to the mean to touch the middle Bollinger Band right there, and next finally we touch the upper Bollinger Band just like what we see in the current trend. So we have those points. We have about 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there is reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So again, the trend that we just examined was December 21st, 2006 to March 22nd, 2007. And it looks like back then the S&P 500 was down around 72 basis points. So not much to the upside and not much to the downside. Most likely we may encounter sideways price action. So that is it. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.